Let's very quickly check it on Wall Street, where trades remain flat. On your screen, the Dow Jones Industrial Average, which is just very marginally in the green, flat really. The Nasdaq Composite Index pretty much at similar levels, just very marginally in the red. Now, like we said a short while ago, despite the fact that you've had third quarter GDP for the US economy come in at a higher than expected reading of 3.1%, this is against analysts' expectations of 2.7 to 2.8. You're continuing to see a whole lot of very negative mood hang over Wall Street, and this is because of the deadlock over the fiscal cliff, where the Democrats and the Republicans can't seem to arrive at any sort of settlement. And just as Barack Obama was saying a short while ago at a press conference at the White House, the difference in the positions that both sides are taking is just a few $100 million, and for that the entire US economy and indeed global markets is being held to ransom. So that is something that the markets will be watching very closely. But for now, until you see some sort of resolution on that front, the breadth on Wall Street is expected to be negative.
And on Europe, where equities took a hit after US fiscal talks stalled once again, and Reuters correspondent Mariam Behmad now joins us with a detailed market wrap from Europe. Mariam?
Well, European stock markets eased in early trade with dented sentiment off the back of losses on Wall Street and in Asia. There seems to be more delay with the U.S. budget talks as we all get closer to that fiscal cliff. Now, the Stocks Europe 600 index is pretty flat, still heading for a seventh straight month of gains. Drug makers were the biggest losers this morning, with shares of Sanofi and Novartis both down more than 0.5%. Telecom equipment firm also taking a hit, Ericsson down more than 1.5%. Banks also feeling the heat. UBS dropped 1% as it faces scrutiny in Hong Kong for possible misconduct linked to the city's rates. Now, the common thought is that investors won't be taking any big positions from now until the end of the year. As for the fiscal cliff, it's in the best interest of both parties to find a solution. So we'll be waiting for more news out of the States.
Mariam Behmad, thanks very much for joining us with that check on Europe. Now let's keep it with the international markets, and we have Tom Elliott, who's global strategist at JP Morgan, now joining us on the show from London. Tom, to begin with, American politicians continue to bicker over the fiscal cliff. Do you think they will reach a deal before year end?
That we won't really see a clear-cut resolution to this in 2013. This represents what was dubbed years and years ago the failure of what's called public choice economics, and this is when politicians basically get grabbed by interest groups, making it very difficult for them to budge. I'll give you an example of this, and that's Obama is resolute in not cutting pensions for public sector workers. Equally as resolute are the Republicans, who do not want to see a resumption of the same tax levels that rich people paid in the days under Clinton and before. So I think we're in for a prolonged period of standoff over this issue.
Prolonged standoff is what we are expecting. But Tom, what's the worst case scenario you are working with right now in the event US fails to reach a deal on the fiscal cliff?
Well, the worst case scenario is that we lose $600 billion of government spending during 2013, which equates to about 4% of the US economy. Now, when the US economy is only growing at around 2%, you're instantly talking about a recession. And with knock-on spillover effects, some economists reckon that if the $600 billion were taken out during 2013, we could see ourselves losing between 3 and 5% GDP growth. I emphasize this is counting in externalities. So that's the worst case scenario. Now, if that were to happen, one should be a seller of US equities. Our view, however, is that we stumble through 2013 with some give, some take on from both sides.
Tom, what about the eurozone? What's your outlook on the region going into 2013?
Our outlook on eurozone economy and stock markets is improving. In 2013, we've seen the ECB take concrete steps to, in its own words, to do whatever it takes to save the euro. Importantly, we've seen the German government do a U-turn on its attitude towards Greece saying that it believes Greece has a future within the euro, which is a turnaround from its position last November. And we're seeing moves towards closer fiscal and economic union, with the moves towards a banking union spearheading that process. These suggest that the euro will not disintegrate. And so we go into 2013 on a much surer footing than we did go into 2012.